From the morning reading, the Qs, IWM have bull flags. Pullback day 2 on a 50% fib retracement. Oil and bonds rise. On the S&P snapshot, the presidential debate, anxiety erases the Fed rally. Major markets around the globe sold off yesterday, with the pundits pointing to the evening U.S. presidential debate as the main source of market anxiety. The benchmark S&P 500 plunged at the open and after a puny bounce, sold off to a narrow mid-range afternoon trading range. The index closed with a 0.86% loss, a tad above its 0.91% intraday low moments before the close. The loss essentially erased the no-rate hike rally that began last Wednesday with the release of the September FOMC statement. The yield on the 10-year note closed at 1.59%, down 3 basis points from the previous close. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:15 a.m. Mountain Time, and I'm recording this in preparation for the market day of September the 27th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, you probably noticed the big absence. I was gone for almost 3 weeks on an extended vacation out of the country where had very limited internet and certainly not the ability to be publishing videos to YouTube. And this morning, as I get everything put back together, it kind of feels like starting up a battleship, getting all these systems back up and running and updated and kind of getting back into the routine. So things are definitely off kilter a little bit today, but we're going to plow on and go ahead and get as much of this going as possible, just kind of get the process going again. Let's first of all start off with the morning report. At the time of this cut, the all four of the broad market U.S. indices were up just above scratch, with only the Russell up more than 0.25%. Crude oil, though, was down big, down 2.61%. The euro down about 0.4%. The bonds up about 0.5%, and gold down about 0.6%. In overseas action, you had China up about 0.6%, Hong Kong up over 1%, Japan up about 0.75%, Germany down about 0.75%, and the United Kingdom down just below scratch. In terms of macroeconomic reports for today in the United States, of note, you have the consumer confidence, and FOMC member Fisher speaking later today. Looking forward to tomorrow, we have core durable goods orders, Fed Chair Yellen testifying, FOMC member Bullard speaking, and crude oil inventories. And then finally in the evening, FOMC member George is speaking. So kind of be aware of that. We do have a number of things on the docket for the early part of this week. In terms of current volatility conditions, things have definitely heated up while I was gone, though the interesting thing is, and we'll get to the charts in just a second, we're pretty much right where we were when I left some 2.5 weeks ago. But in the meantime, volatility has ticked up, and you can see on all four of these indices, we had, when I left, basically about 2 weeks without a single standard deviation move. Well, that's changed since I left. We've got multiple standard deviation moves across all four of the indices, with -1 standard deviation moves put in on all four indices yesterday. Also, you look at the IV percentile, 28 for the S&P, 21 for the Russell Index. The NASDAQ has 23 and the Dow a 29. So significantly higher than they were, though note they're still all red. They're still all in the lower third of their annual ranges. Short-term VIX is also ticked up, though it is not excessive by any means. It's at a 15.67. Skew is below the warning status, so nothing of concern coming from that area. Let's go ahead and go to the charts. And Let's start off with the S&P. And you note that most of the time since it's been gone, the action's been basically sideways in this neutral pattern within the cloud. And basically in a sideways consolidation pattern. Now, you did have the tick down and the big move there right at 2 weeks ago, 2 trading weeks ago. But since then, it's been trading all inside the action of that bar, with a couple exceptions that were rejected. So all closes were within this bar. We are still within the cloud, and frankly, until this thing resolves one side or the other, and really until this breaks out of either 2200 or breaks down below 2100 with a close on either side, a confirmed break of this trading range, nothing has happened. So we basically are right back to where we were at the top of this trading range back here, and there we go. You know, we haven't really broken down, nor have we broken out. So nothing has really, when it's all said and done, nothing of significance has actually happened in the last couple of weeks. The Dow, the same pattern. The NASDAQ. NASDAQ's been stronger, and we have to note that we did have a new 52-week high that were put in just a few trading sessions ago, giving back some of that since, but certainly is in contrast to the S&P and the Dow. NASDAQ clearly stronger. Also, the Russell has been stronger as well. It put in that new 52-week high just before the big down day, but has retraced pretty much all of that, came back up, basically double topped that area and has pulled back from that. So there would seem to be some pretty significant overhead resistance for the Russell at this time. In terms of the crude oil continues to be in a sideways range-bound pattern and has not really broke either way. Gold also still in this consolidation pattern. Still in the cloud even, so very, very neutral. Bonds have been coming up, and this may be one of the signs that there may be more to this weakness that we've experienced in recent trading. Though thus far, remember, the weakness has not actually broken down. We're just inside a trading range. Bonds would seem to be telling us that maybe something more could be happening. Gold also in a trading range. Nothing really happening here. So for the most part, everything's still neutral. September can be sometimes a deadly month for investors and traders, but thus far, while we've upticked in volatility, we've not actually, in quotes, achieved anything of significance. And I think, let's take a look at VIX. Of course, we had the uptick, clear spike in volatility, but then that was pretty quickly crushed, and we're right back down into, relatively low levels. Right now we're at, about a 14.5. So certainly elevated compared to these trading range days, but at the same time, this volatility has largely resolved itself and has come back down into a relatively low area. Okay, let's go ahead and go to our daily report, and a number of changes as you would expect after being gone for 2.5 weeks. In terms of our market timing signals, right now, and I need to double check this, but I believe we're still market phase 3 in terms of the intermediate term phase opinion. I did update all these areas, the market timing signals. We are still with IBD in our first market timing signal. That all three of these are mechanical, remember. The first one is confirmed uptrend. The second one, a pretty weak GMI index at a 2 out of 6, but the buy signal that has been in place since 9/22 is still in place. So that's a relatively new buy signal that came back in, but a 2 out of 6 and an 8 out of 8 on the GMI 2. In terms of stock charts decision point scoreboard, you'll notice that the short term is decidedly weak, and we have, bearish to neutral on 3 of the 4 setups, and the NASDAQ is mixed. Now, intermediate term, things are generally holding up on the S&P and the NASDAQ, though the Dow has deteriorated to a neutral and a bearish signal. A long-term continues to be quite mixed. So really not much here for the bulls, and being able to say that you've got, kind of an all clear signal. It is not that way at all. And indeed, the consensus here is still a slightly bullish bias on the market timing signals using the intermediate term time frames, but yet at the same time there is plenty of asterisk to that statement, plenty of reasons to be concerned. Now on the position sizing opinions, both models are certainly still at 100%, and that certainly is a positive. But don't be just totally mechanical. We use mechanical to be as objective as possible, and then we put all these various variables together to make overall decisions. So you should be exercising some enhanced cautions right now. This is not a clean setup. In terms of the intermediate term market posture, we are on a second day strong bull signal. This had deteriorated while I was gone into a bearish intermediate term market posture, and then with recent action, it's actually turned back up and is at a second day strong bull signal and is supported by a bullish sentiment line. Though I will say that bullish sentiment line has been falling, and you can see here we're still up over 80, so anything above an 80 is considered a bullish sentiment line in terms of the strength of the trend. But bottom line to this is that it certainly is coming down off of its highs. And the Dow, you see this Dow's actually in a strong bear at this point in terms of intermediate term market posture. NASDAQ, severely strong bull, and Russell, strong bull. So less worries coming from those areas, and in general, they're holding up better. These growth, more aggressive, higher beta-oriented parts of the market are holding up better than the more conservative parts of the market at this point. In terms of hedge warning status, I've left this at 0+, normal with some cautionary aspects. I'll continue to weigh this the next day or two as I kind of get back into the swing of things and see if I want to change that at all. This could very easily go to a level 1. I thought about it this morning, but I wanted to kind of do some more reading and do some more study of my various inputs to be able to make that assessment. In terms of strategy opinions, the VIX is inside the acceptable window to initiate new positions for novice traders. Just be aware that things have certainly picked up in volatility, and that should be something of a sign for you. In terms of cover call strategies, much more defensive posture, going to a 2-to-1 ratio of in the money versus out of the money strikes. So it's still given an opinion that conditions are acceptable to initiate new positions for novice traders, and yet at the same time with a 2-to-1 ratio of in the money and out of the money, you can see that's pretty conservative, and about as conservative as we get without just simply not initiating new positions. Same thing for the low beta, high beta positions. Go with 2 low beta positions for every 1 high beta position. Consider legging into cover calls with those more aggressive setups, those high beta positions, legging into those positions by selling out of the money puts. And also keep the position size in the scale you're willing to own and consider reduced position size. Put selling, conditions are acceptable, but again, a bit more defensive than perhaps we were 2-3 weeks ago. So just kind of keep that in mind. We've had a number of warnings fire off, and you see with yesterday's action, market in decline and sharp increase warning fired. Also the volatility ratio warning fired. So 3 new warnings fired. We also had our 7th distribution day on the S&P, so that's also of note. And then finally of note, from a volatility standpoint, is that if you looked at the 10-day out expected move in the SPX, it's now, actually that should be it is now greater than 40, so kind of keep that in mind. In terms of trend base, these are still pretty well holding up. We're strong bull, nothing of note on the New York Stock Exchange, new high, new low. Though in the key intermarket risk aversion indicators, we have 4 of these as marginally risk off. These are very tightly wrapped around each other, but they have negative slopes. And so I went ahead and put these not as neutral, but as all four as risk off, and then the last one as neutral. In terms of sentiment, this has been deteriorating over time, and you can see that the day before was 55, a week ago was 44, and a month ago 63. This has been sliding down for the last several weeks, and we're starting to see a bit more bearish sentiment into the market. When you see the sector specific, look who's holding up. Utilities has now bounced back and now has a short, intermediate, and long-term bullish market posture. So kind of keep that in mind. Also, look at this telecom. So, some of the more defensive-oriented are the ones that are holding up, though I will note that consumer staples are in a neutral down posture. We're starting to get some data rolling through on our new sector, real estate, so you'll start to see that populate. It was the only sector actually yesterday that was positive, and you can see where the rest of them come. So you see the rest of this I'll release out to the members and your report. I'm going to go ahead and cut this off at this point. Market's open. I want to go ahead and get this published and get this out to you. And we'll get back to kind of a normal schedule with the rest of this week and get these market previews out a little bit earlier. Of course, we'll always have to do the disclaimers. If you need more time to read the disclaimers, just hit the pause button. Also note the hyperlink down here at the bottom for the full set of disclosures. In the meantime, manage that risk, and you should see things fall together in a very consistent pattern. And good trading to all.